All right, let's take a look at the third and final video that we're going to make on this same exercise. Just so you know, in a previous video we calculated, we did the requirement A and B. Then we have another video where we redo requirement A and C. And now we're going to do requirements A and D, which involve a financial statement effects template or tabular analysis, whatever you want to call it. So if you have more interest in an exercise with the same numbers using T accounts or journal entries, well then you might want to go ahead and check out those other videos instead. But we're going to go ahead and run through this. So using let's see, it's the same title as we had before. So reporting financial statement effects on bond transactions. All of the facts of the case are the same. If you've seen the other videos, January 1st of 2016, McCone or however they pronounce it, issued $300,000 worth of 6% 9-year bonds for $262,022. Now, as soon as we see this information here, we need to know immediately that these bonds were issued at a discount and that the effective or market rate of interest is some number higher than 6%. And in fact, the market rate of interest is 8%. So what they're saying here is the market rate of interest for similar bonds is 8%. We're paying 6%. We have to discount our bonds because anybody that buys our bonds is going to be getting less interest than they should get. So we give them a discount up front. Okay, if this was a premium, we would do something different. All right, and this is, we're going to pay interest semi-annually or twice a year. So what do they want? They say, show computations to confirm the bond issue. So there's a lot of ways you could do this. You can use a calculator, a financial calculator. I think that would be kind of hard. You might be able to use a table if you had one or access to one. We're going to use the internet. All right. So they've already given us the cash proceeds or the initial carrying value. So this is the initial carrying value. We would also call this the present value of bonds of $300,000 of bonds issued at a discount with these facts. Okay. So I'm going to minimize this and come over here. And let's see here now if I can somehow figure out a way. We've got our information here as to the face value. Face value of the bond, liability amount is $300,000. Our face value or coupon rate is 6%. The market rate is 8%. And years to maturity is going to be 9. And then we're going to change this to semi-annual for the payment interval. And then we're going to press calculate. And what we will find if we do this is a breakdown. Here's the present value of the bond right here. We already have this figure. They asked us for the present value of the principal and the present value of the interest payments. And so that's going to be the sum, or the sum of these two numbers is going to give us the $262.22. So let's go back to our handout and plot those numbers in. And 113,934. And we could have already put this number in here, but if we add these two, we get that. Okay, so that's what we're doing there. And this is something that we did in all of the other videos as well, but I feel like we have time to do 2 things. We don't have time to do 4 things in any one video. So that is this part right here. We did that. Previous video we did the journal entries. Another video we did T accounts. Now we're on the financial statement effects template, and notice that they want us to use negative signs with your answers when needed. Okay, so what's going on here? Well, they've got 3 dates for us. The initial date of issuance is January the 1st, 2016. Then we've got 6 months into the future, and then a full year into the future. Let's see here now. This is I just noticed this. This is a mistake. If you notice up here, they use December 31st of 2016, and down here they're using 2019. So we need to go ahead and fix that. I just saw that. So what happens on the date that we issue the bonds? Well, we're going to have to write kind of small here because I made this as big as I could. But we got cash for the 262.22. Okay, so that's 262,022. Non-cash assets, no impact. Okay. Liabilities, $300,000. And that's the only thing that we should see under liabilities until we pay this bond off. We never mess with the amount of the bond payable. Never, ever, ever. Contra liabilities. Okay. So, now let's see what I do here. Pull the calculator over here right quick. So our liability is $300,000, and we're going to subtract the amount of cash that we received, or the initial carrying amount. Let me back up there. Minus 262,022. All right. So the liability is it's not a liability; it's a contra liability. Is 37,978, and probably ought to put that in brackets. And again, if you're doing this in an actual assignment online, you know, those things are kind of quirky. So you just kind of have to play with it until you get the answer formatted the way they want. But I do want to just take a moment to explain what's going on. We got $262,022 as an asset. And if you think about the accounting equation of assets equal liabilities plus equity, well, 262,022 is not the same as 300. So we have to plot this contra liability account in here so that we have 262,022 as an asset and a net between these two figures of 262,022 under liabilities against the amount of the underlying bond payable. All right. And let's see here now. We have no impact to contributed capital as a result of this transaction. No impact on earned capital. No impact on revenues, expenses, or net income. Okay, so that's all we have to do for the issuance. Okay, I'm going to clear this out. On 6/30 of 2016, we have an interest payment. And so I move this around a little bit, so bear with me here. I may have to move the calculator out of the way for just a moment. Our interest payment is going to be whatever the cash amount is, and or the cash paid is. So $300,000 times 3%. Remember, we have to half it because it's semi-annual. So times 0.03 equals 9,000. And this is $9,000 cash going out. Okay. So cash is going down. So we're going to put that in parentheses, and I'm pretty sure, or a negative sign, whatever, that would be right on your homework. Okay. So what else has to happen? Well, let's clear this out and move it out of the way so we can move our paper back up and get some more information. We already know that we received 262,022, and the effective rate of interest is 8% annually or 4% semi-annually. So we are going to use those two figures to calculate interest expense. No matter how we're doing this, we're going to take the carrying amount, which initially the amount of cash that we received and the bond carrying amount are going to be the same. That only works in the beginning. We're going to multiply that times 4%. All right. And this is going to give us, I'm going to add 12 cents, so we have an even number. This is going to give us our interest expense for the period. Okay, so let's move this down. And the expense itself is actually going up. So we have 10,481 as an expense. And then we also need to recognize that net income is going to go down. Let me kind of clean this up here a little bit if I can. 10,481. So there's a negative impact to net income. But we also need to adjust this contra liability here. And we need to do that by the difference of interest expense minus interest paid of $9,000. Okay, 1,481. And that figure is going to go right here. Again, I can't stress this enough. You know, we are reducing the discount, and so in my mind I want to put this as 37,978 and then enter it as a positive number here. So if we think about this, our carrying amount just went up some on this. Our carrying amount is no longer 262.22. It's that figure plus 1481. All right, and we're gonna need to know that in order for us to handle the rest of this exercise. So that's everything that we have to do, these items here, for this June 30th date. And then for the December 31st, 2016 date, we're going to have the exact same thing for the cash paid. That's always, for this bond, it's always going to be $300,000 times 3%. Again, we do not touch the liability. But in order to calculate interest expense, we're going to take this 1,481 and we're going to add to it this 262,022. And that's going to give us our new carrying amount of $263,503. Now, we don't have to put this figure anywhere. If we were doing an actual amortization schedule, we would have a spot for it. But this is how we're going to calculate, and this is always how we calculate interest expense. So 263,503, and we're going to multiply it by that same market rate of interest of 8% divided by 2, because it's a semi-annual interest payment, or 4%, gives us 10,540. And we're going to enter that over here because the expense has gone up and then net income has gone down. Okay? And we have one more thing that we have to do. The first thing I'm going to do is take 12 cents off. Make this nice and clean. 10,540, that's the amount of interest expense minus the amount of interest paid, minus $9,000 is 1,540, and I'm going to plot that right there. Okay? Again, you know, if I was doing this assignment as a student, I would be very certain that all of my numbers were 100% correct. It's just a matter of whether they want this to be negative and these two to be positive, or if they want the reverse of that. And again, I think the way I did it is best, but I can't argue with software very well. All right, that's it for this part 3 of 3 video.